Hello traders, welcome back to our Babypips course. For today we are still on course 6 of 11 high school, and we have completed grade 9, 10, 11, 12, and then today we are about to continue from 13, currency crosses. And here are the subtopics under currency crosses. And the first one is, what is a currency cross pair? Why trade currency crosses? Currency crosses are trendy. Trade interest rate differentials. Be careful trading obscure currency crosses. And then how to trade fundamentals with currency crosses. How to trade a synthetic currency pair, and why you probably shouldn't. Trading the euro and yen crosses. How to use currency crosses to trade the majors. How cross-currency pairs affect dollar pairs. Then summary of currency crosses. So let's begin by considering the first one. What is a cross-currency pair? And to begin, please roll the intro. So here we are with the very first subtopic that says, what is a cross-currency pair? Now, a cross-currency pair is a currency that appears like this for you: GBP, JPY. They are crosses. Why? Because the Great British Pound or the pound sterling is in one part of the world, while the Japanese yen is in another part of the world. If you wanted to exchange currencies like this for business, you will have to change your currency. For example, you have GBP and you want to do business with the Japanese, in Japan, for example, want to exchange it for JPY, you will have to first of all convert your GBP into dollars, and then you sell your dollar to a Japanese merchant or whatsoever, and then that is when business is going to take place. Why the conversion is needed is because the US dollar is the base currency for doing international transactions. So that is the reason. But today that doesn't happen because of technology, right? So it is not very easy to do the conversion due to technological advances. It happens, but you do not know how it's being done. Your broker is there already behind the scenes carrying out these transactions on your behalf. So technology has made everything easier. Calculating currency cross rates, I can tell you for sure nobody does this. Okay, so let's move on to the next lesson that says, why trade currency crosses? So over 80% of the transactions in the forex market involves the US dollar, because the US dollar is the reserve currency. Most agricultural and commodities such as oil are priced in the US dollar, and now that makes the US dollar to be the reserve currency, and many countries will have to use the US dollar in order for them to be able to execute their trade. For example, countries such as China, Japan, Australia are examples of heavy importers of oil, and as a result they keep huge reserves of US dollar in the central banks. In fact, China alone has 3 trillion US dollar in stockpile. Now, is the US dollar strong or weak today? They ask this question in order for them to be able to know which position to take. Okay, if the US dollar is strong, then you know that GU, EU, they are going to be weak. Okay? So here are the major currencies: GBP USD, Euro USD, USD Swiss franc, USD JPY. They are the major currencies. Okay, then we have commodity pairs, and they are the AU, USD CAD, NZD, USD. Now notice that they are all tied to the US dollar. This doesn't give a trader many options when most of their trading decisions are based on this one speculation. Okay, so for example, in the chart we're looking at, we see that all these currency pairs tied to the US dollar, they are dropping, and only the US dollar is pushing up. Why? Because the US dollar is strong. So if the US dollar is strong, all these other currency pairs which is traded against, right, they fall down. So unlike the forex market, the stock market has a variety of options, because even though some stocks are dropping, there are a variety of other stocks that are pushing to the top side. That is what brings us to trading cross currency, because there will be other options to trade in case a particular currency which is tied to the reserve currency is weak. So we have many other options. So that is about currency crosses provide more trading opportunities, yes, which we just explained. So let's move ahead to the next lesson that says currency crosses are trendy. So here we are on currency crosses are trendy, and so since majority of the forex market will deal with the US dollar, you can imagine that many of the news reports will cause US dollar based currency pairs to spike, and that's what actually happened. Now, so US based currency pairs, they do spike, but others, the trend, cross currencies, the trend. So here's an example of the spike. From February to April 2009, the Euro USD ranged its way up to 1.3700. As you can see, it wasn't a smooth ride at all. So here is the range down to that point. Now, that gives us an idea that the Euro USD at that time was very bullish, was very strong. So let's look at another trend, another pair, to see how the same activity within that period of time. From April 2009, the Euro JPY also rose, but unlike the Euro USD, it made a smooth ride up. This is the cross currency pair, right? Euro and Japanese yen. So because the euro was strong this month, okay, and the JPY was weaker, the euro made a smooth ride upward. So knowing this can tell us that if a currency pair, if a currency is stronger against the US dollar, it will be more stronger when it is traded against a cross currency. So you can use this idea to look for pairs that are trendy and that you will be able to profit from exponentially. So that is all about currency crosses that are trendy. Okay, so let's move to the next lesson: trade interest rate differentials. So what is it about trade interest rate differentials? By selling currencies whose country has a lower interest rate against currencies whose country has a higher interest rate, you can profit from the interest rate differential known as carry trade, as well as price appreciation. So that would be wonderful, right? It's like eating a cake that has sprinkles on top of it. It's very, very delicious. So currency crosses offer many pairs with high interest rate differentials that are prime for these types of trade. This chart we are looking at right now is the Australian dollar against the Japanese yen. If you took a long position on this pair, you would have made lots of profits, not on the trade alone, but you also make profit on the interest rate differential. Now, from 2002 to 2007, the Reserve Bank of Australia had raised its interest rate to 6.25, while the Bank of Japan kept their interest rate at 0. Now, what happened? Like we learned earlier, when you raise your interest rate, okay, it makes the currency strong, but the economy doesn't grow as fast as it should be, right? It is hawkish. Now, when you keep your interest rates low, it makes your economy grow, but it doesn't make your currency stronger. So it is dovish. Now, so compare 6.25% against 0. So which one will become stronger? The AUD, and that's why you see this rise and this rally here, way long to the upside, lots of profits. So now there is interest rate difference here. Now there's also trade on profit. Okay, so anybody who took this trade is going to earn trades on profit and trades on interest rates. So we are going to learn more about interest rate differentials and how to profit from them by learning what is called carry trade. We are also going to learn something called risk aversion. Babypips is going to teach us. So for now, we are learning more, and let's move ahead to the next lesson that says be careful trading obscure currency crosses. Why should we be careful while trading obscure currency crosses, or what's involved? While the euro and the yen are the most liquid crosses, more currency crosses exist that don't even include the euro, US dollar, or even the Japanese yen, and that's why they are called currency crosses. So it is important for us to be careful while trading obscure currency crosses, because while the euro, yen crosses are the most liquid crosses, more currency crosses exist that don't even include the US dollar, the euro, or the yen. And these crosses, they include the AUD CHF, AUD NZD, CAD CHF, and GBP CHF. Now they are called obscure because they are not often traded by most forex traders, and since they are not always often traded, the market is always very, very illiquid, okay, and their spreads can be high, and they have lots of spikes, okay, lots of weeks that can take you out because the prices can become quite volatile many times. So look at this chart here and look at the spikes to the top side. Unless you are a guru in trading currency crosses, you want to trade other currency pairs, okay? People like Cyclopedia who are experienced or professional cross-currency traders, they know how to trade these cross-currency pairs. So here is Cyclopedia on on Babypips. You can follow him, sign up and follow him. He drops news and information that is very, very helpful. So this is what we're talking about, trading obscure currency crosses. So let's move to the next lesson, how to trade fundamentals with currency crosses. So here we are on how to trade fundamentals with currency crosses. So basically what we are learning here is that if a strong economic data comes out of Australia, for example, you might want to look at buying the AUD. But first, your first reaction will be like, okay, if Australia is strong, let me buy Australian dollar against the US dollar. But what you do not take into consideration is that what if the US is experiencing strong economic growth at the same period of time? What's going to happen? Price will go flat. But now that you have known that if a strong economic news is coming from a particular country, in trading currency crosses, what you have to do is match that strong currency against a weaker currency, okay? And then you go ahead by buying that currency that is stronger against the weaker currency. So let's look at this example here. This is AUD USD. You see how flat it is, okay? Price is not trending at all. Now on the other hand, this is AUD JPY. You see how price is trending to the top side, okay? So which is better? Because AUD USD here, they are strong at the same time. There's no significant push or trend whatsoever. But because the AUD is stronger than the Japanese yen, see what happens to price. So that is what we're talking about, or what we are learning here. Find a pair that is very, very strong and then match it against a currency pair that is very, very weak. So if AUD is strong, you can match it against the euro, you can match it against the pounds, you can match it against the Canadian dollar. Just look for something else that is weak and then go long. Yeah, it is called bully. Bully on the pair is very, very important to be a bully while trading forex, okay? So that's all for this section. Let's move on to the next section that says how to trade a synthetic currency pair and why you should and why you probably shouldn't. How to trade a synthetic currency pair and why you probably shouldn't. Interesting. Yes, sometimes institutional forex traders can't trade certain currency crosses because they trade in such high volume that there isn't enough liquidity to execute their order. So in order to execute the desired trade, they have to create a synthetic pair. Now, how to create a synthetic pair? Let's say an institutional forex trader wants to buy GJ, but they can't because there is not enough liquidity. To execute this trade, they will have to buy GU and UJ. Now, we learned earlier in this lesson that these are called legs, okay? So they are able to do this because there's plenty of liquidity in GU and UJ, which means they can make large orders. Remember, they wanted to buy GJ, but they can't because there's not enough liquidity. To still execute this trade, they are buying GU and they are buying UJ, okay? Now, two separate trades. Now here's a diagram about how it goes. I'm not going to explain it. I think it's simple. One is canceling one against another, okay? So but if you are a retail forex trader, you want to be trading like this, I mean, it's going to take a large sum of your account, and it is not advisable for you to do that. You just be holding money in two particular trades. Perhaps that's a trade you don't want to take. I mean, that's a risk you don't want to lock up. And don't forget also margin. Institutional forex traders, they can do this because they have lots of yards. Like when they say yards in forex trading, it's a slang that means billions of units. So if you're not controlling financial instruments worth millions and billions, okay, you don't want to be trading like the institutions they do, okay? Just trade the way you should trade. I mean, that's the example, that's the advice Babypips is giving to us. It says, unless you are trading yards, forget synthetic currency pairs and stick to currency crosses. Okay, so that's all we'll be taking for this lesson. The next lesson is trading the euro and yen crosses. So in this section, we are learning that After the US dollar, the euro and the yen are the most traded currencies. Did you get that? After the US dollar, the euro and the yen are the most traded currencies. And like the US dollar, the euro and the yen are also held as reserve currencies by different countries. So this makes them cross currency. The euro and the yen very liquid cross currency outside of the US dollar. In trading these crosses that involves the euro, the most popular pair you want to pay attention to is the euro JPY, euro GBP, and the euro CHF. Now, news that affects the euro or Swiss franc will be felt more in the euro crosses than euro USD or USD CHF. Now, UK news will greatly affect euro GBP because the euro is traded against the GBP. So if there's a UK news and the economic data or the news shows positive economic data for the British pound, the euro will drop. And also if there's a great economic news that shows positive data for the eurozone, the euro will rise and the GBP will drop. Oddly enough, US news plays a part in the movement of euro crosses. US news makes strong moves in the GBP USD and the USD CHF. This not only affects the price of the GBP and Swiss franc against USD, but it could also affect the GBP and CHF against the euro. So a big move higher in the USD will tend to see a higher euro CHF and euro GBP, and the same goes for the opposite direction as well. So what do we mean by this? Let's say there's a US news that shows positive economic data causing the USD to rise. What will happen is that GBP USD would fall, USD CHF would rise, CHF would fall. In the same vein, a drop in GBP prices, we see that euro GBP will rise up, and a drop in the Swiss franc, we see a rise in the price of euro CHF. Now, trading the yen crosses. Now, the euro JPY has the highest volume of JPY crosses according to the latest triennial central bank survey from the Bank of International Settlement. So the GBP JPY, AUD JPY, NZD JPY are attractive carry trade currencies because they offer highest interest rate differentials against the JPY. So when trading the JPY cross pairs, you should always keep an eye on USD JPY. If the USD JPY breaks a resistance level, you should know that investors, institutional traders, they are buying the US dollar, and they are dumping the Japanese yen. And so what should you do? You can quickly go and look at the Euro JPY, GBP JPY. You see that they are spiking, rising up in the same direction. Now let's talk about the CAD JPY. Canada has one of the highest reserve of oils in the world. And it is one of the major exporter of oil in the world. Okay, the second largest owner of oil reserves in the world, and so Canada benefits from the rise of oil prices. However, Japan is one of the major importers of oil in the world. So take a look at this combination. Canada is the highest exporter of oil. Japan is the highest importer of oil. Okay, so the CAD JPY being paired together, what will happen if the price of oil goes up, for instance? Who will benefit the most? Canada, because Canada is the second largest owner of oil reserves. Then who is going to feel the effect the most? Japan, because Japan is the highest importer of oil. So importer versus exporter, and now what the importer is importing is going up. So who's going to benefit the most? Is the exporter, right, which is Canada. So Canada benefits mostly from price of oil if they spike. Now look at the chart before you. The blue line is the price of oil. The red line is price of the currencies. Okay, see how they move. Now when the blue line is spiking up, look at what happens. Okay, as well, the red line is also going up. Now when the blue line is dropping, oil prices is dropping, what do we see to the red line is also dropping. So Canada enjoys lots of benefit when it comes to prices of oil. So if it is only CAD JPY you want to focus on as a trader, all right, you will make exponential profit knowing that oil prices goes up, CAD JPY will go up. Oil prices goes down, CAD JPY go down. So you can even use fundamentals of oil prices to position yourself. With that, let's move to the next lesson that says how to use currency crosses to trade majors. In this lesson, we are going to learn how to use currency crosses to trade the major pairs. So for instance, if you don't ever want to trade currency crosses and simply stick to trading the majors, you can use crosses to help you make better forex trading decisions. How? Currency crosses can provide clues about the relative strength of each major currency pair. Let's say you want to buy, or you see a buy signal for EU and GU, but you can only take one trade. So what will you do? It is better for you to cross both pairs to see which one is stronger. So the right thing for you to do will be to look at EG cross. You remember you want to buy, you see a buy signal on EU and GU, but you don't know which one to take. Okay, so the best thing for you to do is to cross both pairs. Now you are going to open up EG rather, Euro GBP in one chart, and you open up another chart, GBP USD. Now this is just an example, right? As we are seeing here, if you look at two different charts, let's say you open one chart like this and you open another chart like this. In this chart right now, we can see that the euro has been going down for a very long time. The euro has been going down, so it means that the sterling has been strong. Okay, so if the sterling is strong here, as we see in this cross pair, you can now go and look for another currency pair and buy it. Okay, in this pair here, what we see, look at what GBP CAD is doing. It has been rallying to the top side, creating higher lows. You see, so it shows that the British pound is actually strong, and you can do that again and again and again and again. That is how you can use cross pairs to look for higher trading opportunities. In this example between GBP and AUD, the GBP is weaker here because the British pound and the Australian dollar, they are closely related when it comes to trading. So let's check GBP and JPY to see what is going on with this pair. You see, GBP JPY is going up. Okay, so having this knowledge at the back of your mind can help you to make good forex trading decisions. Okay, so that is what we are learning here. The EG and the GU. Looking at the chart, the blue line is the EG. The EG is going down. However, the GU is going up. So what is the best currency to trade when it comes to the Euro USD and the GBP USD? We have now used the EG as crosses to determine to determine which pair to trade. So the right answer would be to buy the GBP USD because it is stronger. So that's how you use crosses. Look one pair, look another pair, and use it to make a trading decision. Do crosses, okay? So crosses can actually help you. You're looking to buy EU and GU. Look at EG. Just go look at EG. This is the euro, okay, against the US dollar. This is the GBP against the US dollar. You see buy signals here and here. Now you don't know which one to take. How do you know if the euro is actually stronger against the US dollar? And how do you know if the British pound is stronger against the US dollar or is weaker? You are now going to use the euro GBP as a cross pair. So when you open up the euro GBP, if the euro GBP is weaker, okay, if it is going down, then you know the British pound or the sterling is stronger. Now if the GBP USD is going up, that gives you further confirmation that the British pound is stronger. So if the British pound is stronger against the euro, okay, and it's also stronger against the US dollar, that shows you that you should do what? Go with the British pound. Okay, so buying the GU is a better trading opportunity. So now let's look at this area here. Know which currency cross to use. Let's say you are bearish on the US dollar. How will you trade? You can't decide whether to buy EU or to sell USD CHF. What should you do? Look at Euro CHF. In fact, my friends, print this section out. Just print it out, okay? paste it on your wall, on your fridge, or on the front of your computer, or beside your trading desk, okay? And look at this all the time to help you determine which pair to pick to trade, okay? So do that on your own. That's your assignment. Next, let's move to the next lesson that talks about how cross-currency pairs affect dollar pairs. So cross currencies can actually affect dollar pairs. Okay, let's say for example, let's just pretend for example the Feds announced that they want to raise interest rates, and quickly the market reacts. People are buying the US dollar, and major currencies like the EU is dropping, the GU is also dropping, but the USD CHF and the USD JPY is on the rise, right? So you were already on short on the EU, and you notice that, man, I have made a lot of profits. But then you notice that your friend who was long on USD JPY, he made more profits than you, and you're like, what? Really? What happened? It's because of the effect of cross currency pair. You compare the charts of the EU and the USD JPY, and you see that USD JPY made more bigger move. It broke through a major technical resistance level and shot up 200 pips, while your EU barely made 100 pips and failed to break support. Okay, so you were thinking, if the US dollar was really going to be bought across the board, then how is it that my Euro USD trade looks so weak compared to my friend's USD JPY? Answer is due to currency crosses. In this example, the Euro JPY. Now from the example you're looking at, you see the Euro JPY barely made a move above, okay, the resistance level, let's say like 100 pips or so. Then the USD JPY on the other hand made so much move above, the resistance line. So when you compare the USD JPY, it broke through its major resistance level, the red line, and the combination of stop losses being hit and breakout traders jumping onto the bandwagon pushed it even higher. Now since buying more USD JPY weakens the yen, this will cause Euro JPY and possibly other yen-based pairs to break through its major resistance level, once again hitting stops and attracting breakout traders, pushing the EJ even higher. So let me try my best possible to explain the reason why you who sold Euro USD and your friend who bought USD JPY, you are not going to make the same profit. The Feds have announced there's going to be interest rates, and that is going to make the US dollar to be strong. We know that. So you were already on a sell trade on Euro USD, and your friend bought USD JPY. Now your friend bought USD JPY is going to make lots of profit more than you, as we are seeing here, because you sold Euro USD, your friend bought USD JPY. Now this is the resistance level, the dotted red lines for the USD JPY. When price got here, it took our stop losses, more breakout traders entered the market, and price even rallied to the top side. You on Euro USD, your trade could barely break support. Why? Because Euro JPY rather is acting as a soft landing to the Euro USD that way. So while people were shorting Euro USD, people were also buying Euro JPY. So they were buying it that way, they were selling it that way, other people were buying it this way. So it will act as a soft landing. So instead of jumping down in your Euro USD trade, it is not going to make tremendous fall on the other side. So that is the reason why your Euro USD trade did not make much profit like your friend who took just USD JPY. So the next lesson is a summary of currency crosses. So in summary, from all we have been learning, we now know that crosses give forex traders more pairs to trade, which means more trading opportunities, and we normally see cleaner trends and ranges on currency crosses than we do on major pairs. You can also take advantage of interest rate differentials by trading currency crosses. So do your due diligence and analysis and match strong currencies against the weak ones. Okay, if the pair you are looking to trade isn't available with your broker, don't worry. You know how to create a synthetic pair by simultaneously going long or short two major pairs to create one currency cross. The most popular Euro crosses are the Euro JPY, Euro GBP, and the Euro CHF. The GBP JPY, AUD JPY, and NZD JPY are attractive carry trade currencies because they offer the highest interest rate differentials against the JPY. When trading obscure currency crosses, watch out for wide price swings and wider spreads. If you want to stick with major pairs, stick with them. Okay, nothing is wrong about that. You have to be conscious about the pip value of those cross currencies that you likely want to trade, and there are lots of opportunities. Sometimes you'll find them, sometimes you won't find them, and if you want to avoid volatility of US news events, check out some of the currency crosses. You may never know what you find out. And so lastly, a tip here is there is a currency cross forums where cross currency traders are always gathered, and you can click on this link here, babypips.com/t/currency-crosses, and then you find currency cross traders. Okay, so with that we come to the end of grade 13. Okay, my friends, if you enjoy what you have been doing so far, invite your friends, share this video, turn on your notification, please smash the like button for me, subscribe if you haven't, and until next time, I wish you success.